that was the overview. Let's get into a little more detail about this. So we'll look at it, the items that are needed to prepare for a cash flow. Income statement for the current year, balance sheet for the current year, a balance sheet for the prior year so you can compare, and additional information based on the review of the transactions you find in this sheet, such as maybe titles, maybe bill of sales, things of that nature. Journal entries to find out what really was exchanged to make those accounts go up and down. So, and now it takes 5 steps. First of all, you prepare the cash flow operating activities, and then you look at the investing, then the financing, and then you compute the change in cash. And finally, you prepare a schedule of non-cash activities, which very seldom they're rather odd or unique. I don't believe we have any in any of our activities, but just be aware that there could be some. So we'll do these. Now, one thing you have to remember, while this looks relatively easy, it can be complex. So just do one step at a time. Just worry about each one of these at a time. Don't let the whole thing overwhelm you. So you've got your balance sheets this year, last year. Here are your increases, your changes. Here is your income statement with your net income, which is what you're going to need. And you're ready to go to prepare this. And again, this is step 1. We look at the operating adjustments, then we're going to look at the investing, and then we're going to look at the financing. And then we do the comparison to the change in cash. So what are we doing? So we're using the indirect, okay? And again, we're taking an accrual-based income or loss and adjusting it to a cash number. Or we're taking accrual-based and turning it into a cash flow, showing the cash basis. So you're going to look at sales and accounts, and they generate revenues, but they don't generate cash yet until they're paid for. So those would have to be adjusted, which means if accounts receivable increased, we would have to deduct that from net, or we would have to add that back into net income. Simply because, no, we would have to deduct that, I'm sorry. You would deduct that increase in accounts receivable because even though that's in net income, it's not cash, it's on paper. Accrued expenses such as wages, okay, even though we've deducted those, okay, as an expense when we did adjustments, they didn't involve cash because we haven't paid it yet, it's accrued. So those would have to be added back in. Those are the type of adjustments you look for. Now, and then we also look at depreciation and depletion and amortization. While those are deducted from the revenues, there's no cash that's involved in this. It's a paper expense. So those would have to be added back in. Gains and losses on disposal of long-term assets. We're going to add the gains. We're going to remove the gains, okay? And we're going to add the losses back into net income. Why? Because this is all going to play out, let's go back here, when we look at investments. So we've got to take that out of the net income right now, because there's a lot more cash involved than just that loss or that gain. And then we look at changes in current assets and liabilities. And as you can see on this one, here's the depreciation added in, here's the gain removed, here's the increase in accounts receivable removed, here's a decrease in inventory, that's an asset. When an asset decreases, it's added back. There's no money involved in this, right? We've just added it into the inventory. Here's an increase in accounts payable. We're going to add that. and then a decrease in accrued liabilities. We're going to deduct that. And again, please go to the book and get the page that shows how to handle these. Then we're going to evaluate this. We're going to add and compare. So here's our net income. Here are our adjustments of $30,000. We're going to add that to the net income. And we've now adjusted the net income to a true cash total. So this becomes cash, or net cash provided by the operating activities. See, the income showed $40,000. The true cash involvement was $70,000. So as you look at this, you can see we've added and subtracted, and what happens. This is what you'll find in the book, and this is a card or page that you need to write down so that you can remember these and think about why they're added back and forth. Read the book really, really in depth to understand that. So then, now we're going to look at cash flows from investing activities, and I'm going to end this and start a new one for the investing.